Welcome to the video recording on partnership accounts part 2. Okay, so in our earlier session we saw partnership accounts part 1, where we discussed basics of partnership accounts and admission of a partner, right? So today we are going to look at the remaining two portions, which is retirement of a partner and death of a partner. Okay, so what we need to keep in mind when we account for retirement of a partner is that first of all, when a partner retires, the share of his profit is now available to the continuing partners, which means the continuing partner's profit share increases. So what we need to calculate is the gaining ratio. Okay, which means the new ratio of the continuing partners will be greater than their old profit sharing ratio, and the difference is the gaining ratio. So that's the first thing. In case of admission, what did we do? We calculated the sacrificing ratio. In case of retirement or death, we will be calculating the gaining ratio. Okay. The second thing we need to keep in mind is we'll have to settle the retiring partner. When a partner retires and he leaves the firm, we have to know what are the amounts that he is entitled to get. First of all, he is entitled to get his capital. Whatever capital he has invested, whatever is the capital balance, he is entitled to get it back. In addition to this, what happens is partners might decide to revalue the assets and liabilities. So whatever is the revaluation profit or loss, the retiring partner gets his share in the revaluation profit or loss. And most important thing is goodwill. Goodwill is valued at the time of retirement of a partner, and the retiring partner's share in the goodwill has to be made good to him by the gaining partners in their gaining ratio. In addition to this, uh, generally firms take a joint life policy. A joint life policy is nothing but an insurance policy which is taken by the firm jointly in the name of all the partners, and the firm pays the premium for the policy. Okay, so when a partner retires, the JLP is surrendered, and the insurance company pays the surrender value to the partnership firm. So in case and the accounting for JLP itself is a separate topic. So the in case the JLP premium paid has been treated as an expense, then the surrender value of the policy received, the retiring partner share in the surrender value of the JLP, he's entitled to get that also. Okay, and whatever balance is there in the general reserve in the balance sheet, the retiring partner has to get his share in the general reserve. In case there are accumulated losses in the balance sheet, the partner's capital account has to be debited with his share in those accumulated losses. Understand? So this is one thing that we have to understand. What are the amounts that the retiring partner is entitled to get? Thirdly, how is the retiring partner to be settled? The retiring partner can be settled entirely by way of cash, okay, or the retiring partner might agree that whatever amount is due to him might be treated as a loan by him to the firm. Then in that case, he is entitled to get interest on that loan, or he can be settled partly in cash and the remaining can be transferred to his loan account. So this is how a retiring partner can be settled. Okay, so with this in mind, let's look at the questions for the test. Okay, first question is, revaluation account is debited A, on increase in provision for doubtful debts, on increase in value of land and building, on decrease in the amount of creditors, to transfer loss on revaluation. Okay, so we know that revaluation account is a nominal account, and all losses will be debited to the revaluation account, and all incomes or all profits will be credited to the revaluation account. And after all the entries have been put through, if there is a revaluation profit, it will appear on the debit side. If there is a revaluation loss, it will appear on the credit side of the revaluation account. Okay, so if you look at option A, increase in provision for doubtful debts is a loss, and hence I told you all losses have to be debited to the revaluation account, and hence A is the answer. The next option is increase in value of land and building is actually an increase in the value of an asset. So it will be credited to the revaluation account and not debited. And so B is not the answer. Similarly, C, when the amount of creditors decreases, it is a favorable thing for the firm and hence it will be credited to the revaluation account. So C is not the answer. And whenever there is a loss on revaluation, the loss will appear on the credit side of the revaluation account because the debit side is heavier than the credit side and hence the balancing figure will be on the credit side, right? So D is not the answer. So answer is A. Next, partner's capital account is debited. A, to record the profit on revaluation. B, to record general reserve. To record P&L account debit balance. To record the shortage of capital brought in. Okay, so here when we record profit on revaluation, the entry is revaluation account debit to partners capital account. So here we are crediting partners capital account and so A is not the answer. Similarly, when we distribute the general reserve, entry is general reserve account debit to partners capital accounts and so B is not the answer. C is to record P&L account debit balance. Yes, so when we are transferring the accumulated losses, we'll be debiting the partner's capital accounts and crediting the accumulated losses and hence C is the answer. Okay, next. Joint life policy is taken by the firm on the life of A, all partners jointly, all the partners severally, on the life of all the partners and employees of the firm, both A and B. Okay, so when we say joint life policy, it means that it is one policy which is taken jointly on the lives of all the partners, right? So in case it's possible that a separate life policy is taken on the life of each partner, so that case it will be all the partners severally, but here answer is A. At the time of retirement of a firm, the firm gets dash from the insurance company against the joint life policy for all the partners. Okay, so when a partner retires, the JLP is surrendered. Okay, so a joint life policy will mature only at the expiry of the term of the policy or on the happening of the event, which is the death of any one of the partners. In that case, the firm will get the policy value. But when a joint life policy is existing and one of the partners retires, then the firm will get the surrender value from the insurance company, right? Next, at the time of retirement of a partner, the firm gets dash from the insurance company against joint life policy taken severally for each partner. Okay, so here policy the options are A, policy amount, B, surrender value, C, policy value for the retiring partner and surrender value for the rest, surrender value for all the partners. Okay, so here the firm gets the surrender value for all the partners, so D is the answer. Claim of the retiring partner is payable in the following form: A, fully in cash. B, fully transferred to loan account to be paid later with some interest on it. C, partly in cash and partly as loan payable later with some agreed interest. D, any of the above. So as I told you a little while ago, that the retiring partner's claim can be settled either in cash or it can be transferred entirely to a loan account, or it can be settled partly in cash, partly as loan. Okay, so answer is D, any of the above. Then, outgoing partner is compensated for parting with firm's future profits in favor of remaining partners. In what ratio do the remaining partners contribute to such compensation amount? Right. So, in case of admission, we saw that when a new partner is admitted, he has to compensate the old partners in their sacrificing ratio. Okay, so here when a partner leaves the firm, okay, so since he is parting with the firm's future profits in favor of the continuing partners, then the continuing partners have to compensate the retiring partner for this parting, okay, in their gaining ratio. So answer is A. Next, A, B, C and D are partners sharing profits and losses in the ratio of 3:3:2:2. D retires and A, B and C decide to share future profits in the ratio of 3:2:1. What will be the gaining ratio? Okay, so let's just work it out, right? A, just a second. Okay, so A is to B is to C is to D is equal to 3:3:2:2, right? Then D retires, okay, so D retires and A, B and C decide to share future profits in the ratio of 3:2:1. So A is to B is to C is equal to 3:2:1. What will be the gaining ratio? Right. So the gaining ratio of A is equal to new ratio, which is 3/6 minus 3/10. Gaining ratio of B is equal to 2/6 minus 3/10. Gaining ratio of C is equal to 1/6 minus 2/10. So let's take an LCM of 30. So this is 15 minus 9. This is 10 minus 9. And this is 5 minus 6. Okay. So here it is 6/30, 1/30, whereas C is actually gaining by 1/30. So the gaining ratio of A and B is equal to 6:1. So what we understand from this is that it's not necessary that all the partners have to gain. Okay, it's not necessary that all the partners have to gain. It's possible that one or more partners sacrifices in favor of the other partner. So here, while A and B are gaining, C is sacrificing 1/30 from his share. So answer is B, 6:1. Next, X, Y and Z shared profits and losses in the ratio of 1/2:1/8:3/8. Z retires and surrenders 1/9 of his share in favor of X and remaining in favor of Y. The new profit sharing ratio will be how much? Okay. Okay. So here you have three partners, X, Y and Z. They're sharing in the ratio of 1/2:1/8:3/8, which means the ratio is 4/8, 1/8, 3/8. Z is retiring, okay, and he surrenders 4/9 of his share in favor of X. So X's gain is equal to 4/9 of 3/8, which is 12/72. So Y's gain will be 3/8 minus 12/72. Okay, it will be 27 minus 12, which is 15/72. So they're asking us what is the new profit sharing ratio. So the new profit sharing ratio of X will be 4/8 plus 12/72, and the new profit share of Y will be 1/8 plus 15/72, which is 72. 36 plus 12, 9 plus 15, which is equal to 48 by 72, 24 by 72, and the ratio will be 48 is to 24, which is equal to 2 is to 1. So the new ratio between x and y is 2 is to 1. Answer is option B. Okay. Next we come to problem number 10. It says A, B and C are partners sharing profits and losses in the ratio of 4 by 9 is to 1 by 3 is to 2 by 9. B retires and surrenders 1/9 of his share in favor of A and remaining in favor of C. The new profit sharing ratio will be how much? Okay. So here A, B, C are partners. Profit share is 4 by 9, 3 by 9 and 2 by 9. B retires. B is retiring and he surrenders 1/9 of his share, which means A's gain is, sorry, this is 3 by 9 of 1 by 9, and C's gain is, so this is equal to 3 by 81, and therefore C's gain will be 3 by 9 minus 3 by 81, which is 24 by 81. So A's gain is 3 by 81 and C's gain is 24 by 81. We have to find out A's new profit share. It will be 4 by 9 plus 3 by 81, which is equal to 36. 36 plus 3, which is 39 by 81, and C's new share will be 2 by 9 plus 24 by 81, which is equal to 18 plus 24, which is equal to 42 by 81. So A is to C is equal to 39 is to 42, which is equal to 13 is to 14. Okay, so answer is A, 13 is to 14. Next, problem number 11. X, Y and Z are partners sharing profits and losses in the ratio 4 by 9 is to 1 by 3 is to 2 by 9. Y retires and he surrenders 13 by 24th of his share in favor of X and remaining in favor of Z. What is the gaining ratio? Okay. Right. So here you have X, Y and Z who are sharing in the ratio of 4 by 9, 3 by 9 and 2 by 9. Right. Y retires and then he surrenders 13 by 24th of his share. So 13 by 24 of 3 by 9 goes to X. Right. So this is 13 by 72. This is X's gain. So now what is Y's gain? Sorry, Z's gain will be 3 by 9 minus 13 by 72. The remaining share of Y will go to Z. So this is 24 minus 13, 11 by 72. And the question is, they're asking us to find out what is the gaining ratio. So the gaining ratio is 13 is to 11. Right? Answer is A. Now we come to problem number 12. A, B, C are partners sharing profits and losses in the ratio of 4 by 9 is to 1 by 3 is to 2 by 9. B retires and surrenders 1 by 9 from his share in favor of A and the remaining in favor of C. What is the new profit sharing ratio? So here you have to be very careful with the wordings. It says 1 by 9 from his share. It doesn't say 1 by 9 of his share. It says 1 by 9 from his share. So what does this mean? Here the old profit sharing ratio is 4 by 9, 3 by 9, 2 by 9. B is retiring and surrenders 1 by 9 from his share. So from 3 by 9, 1 by 9 goes to A. Okay, and the remaining 2 by 9 goes to C. Right? So now A's share will become 4 by 9 plus 1 by 9, and C share will become 2 by 9 plus 2 by 9. So this is 5 by 9 and this is 4 by 9, which means the new profit sharing ratio is 5:4. Clear? Answer is A. Next. X, Y and Z are partners sharing profits and losses in the ratio of 4 by 9 is to 1 by 3 is to 2 by 9. Y retires and surrenders 13 by 72 from his share in favor of X and remaining in favor of Z. Okay, so what is the gaining ratio? So again we need to be careful about the wordings here. It doesn't say 13 by 72 of his share, it says 13 by 72 from his share. So A is to B is to C, it is 4 by 9, 3 by 9, 2 by 9. Right? Okay, it's not XYZ, it's not ABC, it's XYZ, sorry. So this is X, Y, Z. Okay, and who retires? Y retires. Right? And he surrenders 13 by 72 from his share. So 3 by 9 minus 13 by 72. So this 13 by 72 goes to X. Okay, this 13 by 72 goes to X, and 3 by 9 minus 13 by 72 goes to Z. So this is nothing but 24 minus 13, which is 11 by 72. So the gaining ratio is 13:11. Next, X, Y and Z share in the ratio of 9:6:4. Y retires. X and Z decide to share future profits in the same ratio in which Y and Z shared. What is the gaining ratio? Okay, so here X, Y and Z, X is to Y is to Z is 9 by 15 plus 4 is 19 is to 6 by 19 is to 4 by 19. Okay, and Y is retiring. X and Z decide to share future profits in the same ratio in which Y and Z shared. So Y and Z shared in the ratio of in the relative ratio of 6:4. So now X and Z are deciding to share in the ratio of 6 by 10 and 4 by 10. Okay, Y and Z, same ratio as Y and Z, 3:2. Relative ratio is 3:2, which is 6:4. So X and Z are deciding to share in the ratio of 6:4. Right? Now they're asking us to calculate the gaining ratio. So the gaining ratio of X will be 6 by 10 minus 9 by 19. Okay, so we'll take the LCM as 190. So 19 into 6, 114. It's 114 minus 90, which is equal to 24 by 190. Right? And Z's gain is 4 by 10 minus 4 by 19. Okay, so that will be 4 into 19 is 76. 76 minus 40, right, which is equal to, writing it here, it's equal to 36 by 190, which means the gaining ratio between X and Z is 24:36, which can be further reduced to 2:3. Right? So this is the gaining ratio. Next, A, B and C are partners sharing profits and losses in the ratio of 2:2:1 respectively, with capital balances of rupees 1 lakh for A and B, for C rupees 50,000. B declared to retire from the firm and the balance in reserve on the date was rupees 30,000. If goodwill of the firm was valued at rupees 60,000 and profit on revaluation was rupees 14,100, then what is the amount that will be transferred to the loan account of B? Okay, so here we are basically they want us to calculate what is the amount that is to be paid to B as his settlement. So he has to be first of all paid his capital balance. Okay, capital balance is 1 lakh. Next, he has to be paid his share in the reserves, share of reserves. Reserves appearing in the balance sheet is how much? It is appearing at 30,000 and B share is 2 by 5. 2 by 5 of 30, which is 12,000 rupees. Okay. Next, goodwill. Share of goodwill. Goodwill is valued at 60,000. So it will be 2 by 5 of 60. It will be 24,000. Okay. And then profit. Share of profit on revaluation. It is 2 by 5 of 14,100. So it is 14,100 divided by 5 into 2, which is 5640. Total of this will be 1,41,640. So this is the amount to be transferred to loan account. Right? So answer is A. Next, A, B and C are partners sharing profits and losses in the ratio of 3:2:1. C retires on a decided date and goodwill of the firm is to be valued at rupees 1,20,000. The amount payable to retiring partner on account of goodwill will be, okay, so what is a C share? It is 1 by 6. So 1 by 6 of 1,20,000 is 20,000 and so C is the answer. Next, A, B and C are partners sharing profits and losses in the ratio of 3:2:1. A retired and firm received the JLP as rupees 15,000 appearing in the balance sheet at rupees 20,000. JLP is credited and cash is debited with 15,000. What is the treatment for the balance in the JLP? Okay, so right, so here what is happening is the JLP is appearing as an asset in the balance sheet at rupees 15,000, sorry, at rupees 20,000, and when the policy is surrendered, the money received from the insurance company is rupees 15,000. So when JLP is appearing as an asset in the balance sheet, then the cash that is received has to be compared with the value which is there in the balance sheet. Okay, so what value has been received is less than the value appearing in the balance sheet, and so the difference is a loss which is to be debited to the revaluation account. An alternative is you can directly debit the loss to the partner's capital accounts in the old profit sharing ratio. So answer is either B or C. Next, balances of Messrs A, B and C sharing profits and losses in proportion to their capitals stood as follows. Capital accounts 6 lakhs, B 4 lakhs, C 2 lakhs. A desired to retire from the firm and the remaining partners decided to carry on. JLP of the partners surrendered and cash obtained is 1,20,000. What is the treatment for JLP? So in this problem it is not given to us whether JLP premium paid is treated as an asset or it is recorded at surrender value in the balance sheet. In case JLP premium paid is treated as a loss, or rather it is treated as a charge every year, then whatever policy money is received has to be directly credited to the either to the revaluation account or you can directly credit it to the partner's capital accounts. Okay, so if that is the case, then option A is the correct answer. If JLP premium paid is not treated as an expense. Instead, the JLP is shown in the balance sheet as an asset at its surrender value. Then the surrender value received from the insurance company will be credited to the JLP account. Understand? So B will be the correct answer if JLP is appearing in the balance sheet at surrender value. So C is definitely not the answer. So answer is either A or B. Next. Balances of Messrs A, B and C sharing profits and losses in proportion to their capital stood as follows. Capital accounts is 4 lakhs, B 6 lakhs, C 4 lakhs. JLP reserve is lakh and 60, JLP is lakh and 60. A desired to retire from the firm, and the remaining partners decided to carry on an equal ratio. JLP of the partners surrendered and cash obtained is lakh and 60. What will be the treatment for JLP? Okay, so here JLP is appearing in the balance sheet on the asset side at its surrender value, and correspondingly a JLP reserve has been created, and that's appearing on the liability side as a reserve. Okay, so when a JLP reserve is created and a policy is surrendered, whatever balance is there in the JLP reserve has to be distributed to all partners in their old profit sharing ratio, and the money that is received from the insurance company has to be credited to the JLP account. Right, so the entries are, when you receive the money from the insurance company, entry will be bank account debit to JLP account. With this, the JLP account gets closed, and you don't need the JLP reserve anymore because the policy has been surrendered, and so the reserve, the profits that have been set aside every year, will now be distributed to the partners, and all the partners in their old profit sharing ratio. So here the answer is B. JLP reserve balance credited to partners' capital accounts in old profit sharing ratio. Okay. Next, balances of Messrs A, B and C sharing profits and losses in proportion to their capitals stood as follows. Capital accounts: A 4 lakhs, B 6 lakhs, C 4 lakhs. A desired to retire from the firm, and the remaining partners decided to share future profits equally. Goodwill of the entire firm is valued at rupees 2 lakh 80, and no goodwill account is being raised. Right? So here they're asking us how are we supposed to account for this goodwill valuation. So goodwill, we must understand that goodwill should never appear in the balance sheet as an asset. It is not allowed to show self-generated goodwill as an asset in the balance sheet. Okay, so in this case what we have to do is we have to find out the retiring partner's share in the goodwill, and that has to be compensated by the continuing partners in their gaining ratio. So what we have to first of all calculate is the gaining ratio. Okay, so let's calculate the gaining ratio first. So they are saying that A is to B is to C are sharing in the in a ratio which is proportionate to their capitals. So it is 2 is to 3 is to 2. Right? And A is retiring, and B and C are going to share equally. So what is the gain of B? It is 1 by 2 minus 3 by 7, which is 7 minus 6, which is 1 by 14. And C's gain will be 1 by 2 minus 2 by 7, 7 minus 4, which is 3 by 14. So the gaining ratio is 1 is to 3. Right? And the goodwill of the firm is 2 lakh 80, and the retiring partner's share is 2 by 7 of that. Okay, so it is 80,000, and this 80,000 has to be compensated by B and C in their gaining ratio of 1 is to 3. So it's 20,000 and 60,000. Okay, so answer is C. Next, balances of Messrs A, B and C sharing profits and losses in proportion to their capital stood as follows. Capital accounts: rupees A 4 lakhs, B 6 lakhs, C 4 lakhs. JLP reserve is lakh and 60, JLP is lakh and 60. A desired to retire from the firm, B and C decided to share future profits equally. JLP of the partners surrendered cash obtained is lakh and 60. Goodwill of the entire firm valued at 2 lakh 18. No goodwill account is being raised. Revaluation loss is rupees 20,000. Amount due to A is to be settled on the following basis: 50% on retirement and 50% within 1 year. Total capital of the firm is to be the same as capital before retirement. Individual capitals in their profit sharing ratio. Find the balances of partners' capital accounts. Okay, so here if you see, a lot of information has been given to us. But if you read the last line of the problem, we will know that we are not required to use most of the information that is given to us in this problem. Okay, so what you have to remember is, when you have such a lengthy problem, it is advisable to first read the last line of the problem and then decide if you need to use most of the information that is given in the problem. Okay, so here they're asking us to just find out what are the balances of the partners' capital accounts. And they're saying that the total capital of the firm is to be the same as capital before retirement. So the total capital of the firm before A retired is 14 lakhs, right? And B and C want to share profits in future equally, and in future they want to maintain their capitals also in the profit sharing ratio. So now it's very simple. Total capital of B and C is to be 14 lakhs. They are going to share equally, and they want to maintain their capitals also in their profit sharing ratio, which means the individual capitals of B and C should be 7 lakh each. Okay, next. Balances of A, B and C sharing profits and losses in the ratio of 2:3:2 stood as follows. Capital accounts is 20 lakhs, B 30 lakhs, C 20 lakhs, JLP is 7 lakhs. B decided to retire from the firm, and the remaining partners decided to carry on with the future profit sharing ratio of 3:2. JLP of the partners surrendered and cash obtained 7 lakhs. What will be the treatment for JLP? Okay, so JLP is appearing in the books at 7 lakhs. So they are receiving 7 lakhs as from the insurance company. Entry will be bank account debit to JLP. That's all. So answer is D. Next, on the death of a partner, his executor is paid the share of profit of the dying partner for the relevant period. This repayment is recorded in the P&L suspense account. See, just unlike in case of a retirement where the date of retirement can be decided, the date of death can never be planned. So what happens is, suppose a partner dies in the middle of a year, then his representatives are entitled to get the deceased partner's share in the profits for that period, okay, for which he has worked in the firm. And in order to determine the profit that the firm has made during that period, we open an account called P&L suspense account. A, B and C are partners sharing profits and losses in the ratio 9:4:3. They took a JLP of 5 lakh 44. C died. What is C's share in the JLP amount? Okay, so C's share is 3/16, and so 3/16 of 5 lakh 44 is 34. 3/16, yes, 3 divided by 16 into 5 lakh 44. 5,44,000 divided by 16 into 3 is lakh and 2,000. Okay, next, A, B and C are partners sharing profits and losses in the ratio of 2:1:1. Firm has a JLP of rupees 2 lakh 40, and in the balance sheet it's appearing at surrender value, that is 40,000. A died. How is JLP account going to be shared amongst the partners? So JLP is appearing in the books at 40,000. You are receiving 2 lakh 40. So compare 40 with 2 lakh 40. Difference is 2 lakhs. That 2 lakhs has to be distributed amongst all partners in their old profit sharing ratio, which is 2:1:1. So 2 lakhs is distributed as 1 lakh 50,000 and 50,000. A, B and C are partners sharing profits and losses in the ratio of 7:5:4. C died on 30th June 2006. It was decided to value the goodwill on the basis of 3 years purchase of the last 5 years average profits. If the profits are 53,600, 57,400, 57,800, 48,000 and 26,800, what will be C's share of goodwill? So we have to here use the average profits method of valuing goodwill. So it is 53,600 plus 57,400 plus 57,800 plus 48,000 plus 26,800 divided by 5 into 3. This is the value of goodwill, which is lakh and 46,160, and C share is 4 by 16, which is 1 by 4. So divided by 4 is 36,540. Okay, so answer is A. A, B and C are partners sharing profits and losses in the ratio of 7:5:4. C died on 30th June and the profits for the accounting year 2005-2006 were 48,000. How much share in the profits for the period April 1, 2006 to 30th June will be credited to C's account? So the profits for the full year is 48,000. C has died on 30th June, which means he has worked for 3 months. So he is entitled to get his share in the 3 months profit. So profit for the full year is 48,000 rupees. Okay, so the full year profit is 48,000 rupees. So profit for 3 months will be 12,000 rupees, and C share in that is 4 by 16 or 1 by 4, which is 3,000. So C is entitled to get 3,000 rupees as his share of profit. If 3 partners A, B and C are sharing profits in the ratio of 5:3:2, then on the death of a partner A, how much B and C will pay to A's executor on account of goodwill? Goodwill is to be calculated on the basis of 2 years purchase of the last 3 years average profits. Profits are given to us. So we have to first of all calculate the average profits, which is 6,58,000 plus 6,92,000 plus 8,10,000. Okay, so the average profits is 7,20,000. We have to multiply it by 2 to get the value of goodwill, which is 14,40,000. A dies and he gets 50% share in the profit, so divided by 2, 7,20,000 is A's share of goodwill. Now B and C have to compensate A's executor in their gaining ratio. A, B and C's future profit sharing ratio is not given to us, which means that they are going to continue to share in their relative profit sharing ratio of 3:2. In that case, the gaining ratio is also 3:2, which means we have to distribute the 7,20,000 in the ratio of 3:2, which means B has to compensate by 4,32,000 and C has to compensate by 2,88,000. So answer is D. Next, A, B and C take a JLP in their PSR and their PSR is 2:2:1. On B's death, A and C decide to share profits equally. They had taken a JLP of rupees 5 lakhs with the surrender value of rupees 1 lakh. What will be the treatment in the partner's capital account on receiving the JLP amount if JLP is maintained at surrender value? So here JLP is appearing in the books at a surrender value of rupees 1 lakh. What they receive from the insurance company is 5 lakhs. So 5 lakhs minus 1 lakh, 4 lakhs is what has to be transferred to the partners, to all the partners in their old profit sharing ratio. Next, A, B and C take a JLP in their profit and their profit sharing ratio is 2:2:1. On B's death, A and C decide to share profits equally. They had taken a JLP of rupees 5 lakhs with the surrender value of rupees 50,000. What will be the treatment in the partner's capital account on receiving the JLP if JLP is maintained at the surrender value along with the reserve? Okay, so reserve is appearing in the books at 50,000 and JLP is appearing at surrender value of 50,000. So when you receive 5 lakhs, Okay, so the entry will be bank account debit 5 lakhs to JLP 50,000, and the remaining 4 lakh 50 will be distributed to all partners in their old profit sharing ratio. Now we don't need the JLP reserve, so that JLP reserve also has to be distributed to all partners in their old profit sharing ratio. So the answer is D, both B and C. A, B and C are partners sharing profits and losses in the ratio of 5:3:2. They took a JLP of rupees 60,000. On B's death, what is the amount payable to each partner? Okay, so you get the policy value of 60,000 and it is to be distributed to all partners in the ratio of 5:3:2. So 60,000 will be distributed in as 30,000 to A, 16,000 to B and 12,000 to C. Okay, so with this we come to the end of the video session on partnership accounts. In case you have any queries, please feel free to mail us. So until next time, goodbye.